Today, we're going to show you how to trade AI chip stocks using 3 different modes of explanation. As a beginner, as a professional trader, and as a hyper specialist.
And these 3 perspectives will give you deeper insights on how to take advantage of this time window. And then you can choose the exact strategy that fits your capital and your risk tolerance. If you're a beginner, your starting point for trading these stocks is simple. Are you willing to invest $100,000 to try to make 10 grand, 20 grand, 50 grand, and have the entire risk of if they collapse on your hands? That's one of the beautiful things about options. You can go after those big gains, $10,000, $20,000, but with an option, you only have to invest the premium of that option. So you might be able to spend a couple $1,000s on an option and still make 5x or 10x or 20x. And the best part about an option that no one tells you is that it can only go to 0. In other words, you don't have to have the entire $100,000 at risk in order to go for a big outsized return. The 2 simplest are a regular call or a regular put. Buying a call, that means you are bullish, you want it to go up. If you buy a put, that means you are bearish, you want it to go down. In this case, we're assuming that we expect Micron to go up and we probably want to buy a call option. And there's 2 core pieces of buying a call option. One is time. That's what we call the expiration date. How far out are you buying that call option? You could buy it 1 day away, 100 days away, or multiple years away. How much time are you giving the trade to make its move? The second thing is the price target. We would call this the strike price. So you could trade a strike price right around the current price, which basically means any movement in the stock is going to start to benefit the option. Or you could trade a distant strike price. That means you don't just want the stock to move up above where it currently sits, you want it to move up far higher. By a combination of those, you're going to get the price of the option. Let me give you an example. If I buy an option right around the current price and I give it years to make a move, it's going to be an extremely expensive option. I am saying I want the price of Micron to just go up at all above the current price, and I want to give it tons of time to make that move. At the same time, imagine I wanted to trade Micron bullishly and I want it to go up $100, but I'm only going to give it 2 days to make that move. The market is going to look at that and say, it's not very likely that Micron's going to go up $100 in just 2 days. Therefore, they're not going to charge you a very high price for that option because it's so unlikely to be profitable. As a beginner, that's your job. Find a reasonable balance between time and expected price. So if you're a beginner trading options, there's one major hurdle that everyone should know. It's called time decay. As a matter of fact, when you buy an option, it's kind of like putting an ice cube on a hot plate. As soon as that option is bought, it starts losing value every single moment of the day. Even if the stock is moving in your direction over time, if it's not moving fast enough and far enough, that option is actually still losing value. So for example, let's say Micron's trading at $900. I buy an option for $1,000 strike price. Remember, that's my target. 2 weeks later, Micron's at $909. Great. It's gone up 1% in 2 weeks. So my option should be up about 10%, right? Well, you open your brokerage, you look at the option, it's down 10% or even 15%. What happened? You bought an option on a stock and the stock actually went up. The problem is it didn't go up fast enough and far enough to make up for the time decay. So the issue with options in general is that you have to get in and get out, and the stock pretty much has to be moving in your favor the whole time, or time decay is going to start taking over and losing you money. There's definitely oversimplification as we look at this through the lens of a beginner. Let's see how a pro handles the more complex areas of this.
If you're a pro, your starting point is tactical. It comes down to tracking institutional order flows, not stock charts. So when the AI revolution first started a couple years ago, all eyes were on Nvidia. It was the most obvious layer of the AI value chain. But eventually, as more and more investors piled into Nvidia, that trade got crowded. So in order to make the same kind of returns or even better returns, well, you had to go deeper into the AI value chain. So what does the AI value chain actually look like? It's helpful to think of it as a pyramid. Now, at the top of the pyramid, you have Nvidia. This is the highest level brain of the entire AI revolution. But what does a brain need in order to function properly? Well, it needs a high functioning memory. And that brings us to Micron, SanDisk, a little below on the pyramid. Now, to make the memory components and the high-level logical brain of Nvidia, you need a factory that can actually create all the components. And that's where companies like TSMC and ASML come in. And to build the silicon wafers that the entire AI revolution, all those trillions of dollars depends on, you need the raw materials, the miners who actually harvest the resources out of the earth. So now that we know institutions, hedge funds, and big money are going to be working their way down the AI value chain, the next questions become, well, what are they making their next big bets on, and when are they making them? We can see exactly what big bets they're making on what stocks and when they're making them through the options flows.
This is why order flows beat stock charts. A chart tells you where a stock has been, but options flows tell you where the whales are putting money right now and what they're looking to buy next. Catch that, and you're early instead of being late.
To hunt these whales and find the right signal, you need a specialized data filter that pulls back the curtain on the options market. As a pro, your success comes down to anchoring your trade as close to the whales as you can. Look for orders with a bigger premium size. I try and focus on orders that are above 500K in options premium because it filters out the noise. The bigger the order, that means the bigger the participant is who is placing that order, and also the higher conviction that they have. One 500K order is great, but you know what's better than one? Two. You know what's better than two? Three. The more orders you see at or around the same strike and expiration, the bigger conviction you can bet that trade is, because it signals maybe one big player is making multiple bets, or multiple players are making their own bets at the same strike, the same expiration on the same stock. Big money, hedge funds, institutions, they often know something might be coming up on a stock, but they are human. Sometimes they just don't know when it's going to happen. If you take a weekly expiration, you might be right that SanDisk or Micron is going to announce some big news that would send the stock soaring. Instead of doing it 2 days from now, they announced the news 2 weeks from now. And you missed out because you took the shorter expiration and you are already out of the trade. That's why I always recommend taking at least a 45-day to expiration option. That way you have time for the trade to play out. You have time to let the trade and the thesis work in your favor. I built a software called the AlphaFlow dashboard. My AlphaFlow dashboard specializes in detecting the multi-million-dollar bets that can only be created by institutional investors or hedge funds with extremely deep pockets. Retail traders simply can't create those big of orders. So if you've been options trading for any length of time, you probably know that options are usually used by big hedge funds and institutional money as hedges. If a hedge fund is long Apple in a very big way, well, maybe they buy some puts just to limit the risk they might face if Apple does end up selling off. However, the AlphaFlow dashboard utilizes the very same AI we're talking about today to actually filter out these hedges. Using a machine learning algorithm, it identifies which options trades are hedges and doesn't display them. That way, and you see a multi-million-dollar bet, you know that big money is betting that stock is going to go up. When a stock makes a quick pop, nothing will beat the returns of a long call option. But sometimes you might not be playing a short-term game.
If you're a hyper specialist, your starting point is taking the long-term view and trading with a positive mathematical expectancy. So for example, a stock like Micron will have some of the highest implied volatility in the entire stock market. In other words, it'll charge you a ton for the premium, the extra price of the option, because the market knows what kind of potential Micron has. And that's really the biggest pain point with level 1 options, regular calls and regular puts. As a hyper specialist, the key here is twisting the options to still give us a great opportunity, but not deal with the pain points of level 1 options. So the way that we trade a debit spread, which is my favorite way to trade these opportunities, is that we buy a call and we sell a call at the same time. So for example, a call option on Micron a year from now might be a $15,000 option. But if you're also selling a $14,700 option at the same time in one trade, the net remaining cost is just $300. And that's the beauty of a debit spread. It's taking out all of that implied volatility just by the structure of the trade. The biggest advantage, in my opinion, is that you have what we call a line in the sand. When you trade a debit spread, you know what a winning trade versus a losing trade is as soon as you enter the position. Let's say that you're trading the 245, 250 SMH debit spread. That 250 sold call represents the price at which, if you finish above that level on the expiration date, you win. Period. End of story. You make a full profit. If you finish below the 245, you lose, and you know exactly what price that is before going in. With a debit spread, time becomes your advantage. In other words, if SMH has a 245, 250 debit spread and price shoots up to 270, now you have time on your side. Because if SMH just goes sideways for 3 months at $270 a share, your trade is going to be worth full value because it's above that $250 line in the sand. And all it has to do with is how much time you give the trade. In other words, how far away is your expiration date? And then how aggressive are you going in terms of price? Okay, so imagine you're trading SMH and you think that the ETF as a whole has a chance to go up at least 25% over the next year to 18 months. Now you can go ahead and set up a debit spread that targets that exact level with a massive ROI. And the reason is simple. Most things don't go up 25% over the course of a year, especially ETFs because that's a basket of stocks. Meaning the market is going to price that spread very inexpensively. With a debit spread, you don't have to pay for that time, only really the odds of success. So if you go set up what we would consider a normal spread, which might be $5 wide, you're probably going to pay less than $1 for that spread. In other words, you'll have about a 400% ROI potential even on a 25% move in the ETF itself. Let's say, for example, that SMH is trading around $600 right now, and we think over the next 18 months, it can go to $700. And we're gonna trade a $5 wide spread targeting $700. The $700 spread might cost about $1.30, and that would give you about 184% ROI. As soon as you go higher in price, that debit spread is going to get cheaper because it's a more aggressive trade. For example, if you target $1,000 a share, you might pay about 50 cents for that spread. In other words, you have about 800% ROI left on the trade. Or if you went all the way off to $1,200 a share, now you could probably buy that $5 wide debit spread for just 25 cents, which means you would have about a 1,800% ROI opportunity just based on that $5 wide spread using the math.
Being right about a stock's direction, even with these soaring AI chip stocks, that'll only get you so far if you don't have the right trade structure.
And now if you found this video useful, we've left a link below where you can actually get direct access to Alex's Flow Radar tool. And you'll actually get my complete step-by-step debit spread strategy materials as well.
What should we cover next? Well, let us know in the comments.
And thank you for watching.